Could you defend your business value with data? Before you sell, borrow, grow, or plan succession, know what your business is truly worth.
The U.S. Bureau of Labor Statistics has provided an insightful statistics that it says, business owners that go into business within the first year, approximately 20% of them fail. Within 5 years, approximately 45% of them fail. And within 10 years, approximately 65% of them fail. Within this video, I wanted to talk about how a valuation report with an annual cadence of producing that report and analyzing it can help within your control, be able to minimize the probability of default and being in that statistic bucket of failing within the first 10 years. So it's a survival problem. Many business owners don't fail because of lack of effort. They fail because they can't perceive and visualize the risk before it appears. Cash flow, leverage, customer concentration, pricing, and poor timing. Those are all factors to why they end up in that statistic bucket of approximately 65% of them failing within the first 10 years. A valuation report helps turn risk into dashboard before the risk becomes a crisis. Annual valuation is not only about what could I sell for, it's a disciplined checkup on the variables that threaten survival. Cash conversion, debt capacity, profitability, reinvestment, and risk concentration. A valuation report turns owners' intuition into a documented decision framework. Most owners know revenue and profit, but they often do not know what the business is worth, what drives the value, or how value changes as the company grows. Annual valuation creates four of the following things. First, a defensible price range for selling, buying in, buying out, or succession. Second, a financing narrative for banks, SBA lenders, and private capital. Third, a governance record for partner disputes, divorce, estate planning, and buy/sell planning. And finally, fourth, a value road growth map that shows which key performance indicators move enterprise value. Pragmatic valuation report should quantify value, explain the method, and show the drivers behind the number. We want to know, what are the value conclusions? What's the methodology? Is it income, market, asset approaches combined with company specific risk factors? Third, benchmarks. Are you outperforming or underperforming your peers in the same industry? And four, actionable insights. A roadmap to improve cash flow, profitability, working capital, and risk profile. We leverage and utilize technology-enabled valuation discovery. The software helps organize the data. BizCPAs improves the judgment behind the inputs. We utilize historical figures, tax returns, financial statements, debt, owner pay, and balance sheet inputs, projection inputs, which is important because if the inputs are garbage, the outputs are also going to be suboptimal as well. So forward-looking assumptions, normalized earnings, risks, and scenarios. Decisions, outputs, value conclusions, key performance indicators, lender narrative, and owner action plans. So what are the other scenarios where a valuation report would be warranted? And the first would be when you want to sell the business instead of fair selling price. Owners should not enter negotiations with only a guess, a revenue multiple, or a number they need. A valuation report helps define a credible range before the first buyer conversation even starts. Clarifies the asset sale versus equity value. Identifies whether goodwill and customer base are being recognized. Supports purchase price allocation discussions. And reduces the risk of underselling the owner's largest assets. For the seller's question, what price can I defend with data? The report provides an objective starting point for negotiations by separating business operations, assets, debt, cash, and goodwill. Another scenario would be when you want to expand your operations and need capital. So secure bank loans and growth capital. Lenders care about repayment capacity, collateral business durability, and owner equity. The narrative should be a valuation report complements financial statements by explaining the quality of earnings, value drivers, and debt capacity behind the borrower. It'll focus on interest coverage, ability to service debt, cash to debt, liquidity cushion, the debt to equity, which is part of the capital structure, and the cash flow to revenue, self-funded growth. The third scenario would be when you want to figure out ways on how to minimize the probability of failing or default. And by doing that is visualizing what the value company is and understanding not only the value drivers, but also the risk drivers to the downside. And within that ethos, what we want to do is utilize the technology and the software that we have and make sure that we have as precise as inputs that we could formulate to mix those and marry those together to produce a precise valuation report at that moment in time. and track how that valuation report changes as the business either grows or it weathers slowdowns or contractions in the economy that it operates in. So valuation does not guarantee survival, but it can reduce blind spots by forcing owners to quantify cash, leverage, liquidity, and downside cases. So how do we quantify that risk after producing a precise valuation report, or as precise as we can in that moment in time? Well, we're going to be focused on the 4 things. Cash flow coverage. Can the business convert revenue into cash after owner pay, taxes, capital expenditures, and debt service? Debt capacity. What level of borrowing is rational/optimal relative to normalized earnings and enterprise value? Because at moment in time, if you mix cost of debt and debt financing with equity financing, you may be able to get a mixture cost of financing, which is called the weighted average cost of capital, that is lower than either equity, cost of equity or cost of debt at that moment in time. The third is implementing downside scenarios. What happens to value and liquidity if the sales drop, margins compress, or customers leave? And fourth, covenant readiness. Which key performance indicators should be monitored before banks, partners, or vendors become concerned? And the owner's lesson, the earlier you quantify the risk, the more choices you have before lenders and banks force that type of liquidation. And fourth, not really so much of a scenario, but a benefit is of having a valuation report done annually or every other year is you get to manage the value like the key performance indicators. You're seeing the conglomerate of independent variables that come together to give evaluation statistics at that point in time. So value drivers to monitor would be profitability, cash conversion, debt burden, owner dependence, and customer concentration. So within profitability, higher earnings usually drive higher value, cash conversion, cash flow quality impacts risk and financing, debt burden, lower debt relative to income generally improves value, owner dependence, less key person risk supports stronger multiples, and lastly, customer concentration. Diversification may improve buyer confidence. The fifth is a situation or scenario where a valuation report would help facilitate an analysis to come at an optimal conclusion and decision. It would be to plan for retirement, estate, and succession. For many owners, the business is the largest retirement asset that they have, but it's often the least planned. So valuation reports help answer how much of my net worth is tied to the business? Can the business fund my retirement goal? What happens if I transfer ownership to family? Can I do it in a tax efficient manner? Do I need life insurance or a funded buy-sell agreement? Which value drivers must improve before an exit? So first, you want to know the value today versus value needed at retirement. You would want to know family transfer, management buyout, or third-party sale. And also, to reduce surprise, document value trends before tax, death, or exit events. So I want to just take a moment out of your time today and in this video to let you know that if you found this information useful and find utility in it, so please hit that like button. We'd really appreciate it, and more so, follow us on social media. At BizCPAs, we strive to serve our clients in a fiduciary capacity because we understand that our growth is a derivative of their growth. So back to the video. Another scenario, which would be the sixth scenario, where a valuation report would be warranted, would be in the situation where it helps resolve partner disputes and buy-sell issues. Annual valuation reduces the chance that partners only discuss the value after the trust has been broken down. So the annual baseline value is documented before dispute, buy-sell formula, partners agree on how value is measured, trigger event, death, disability, exit, divorce, termination, and then what is a byproduct? Fewer surprises, a governing procedure and document that helps resolve contentious discussions and conflict between both parties, and reduces litigation risk and friction, which we understand that that can be costly, and if you have the proper governance procedures in place, you can avoid those costs. So practical use cases also are partner buyouts, minority shareholder exit, divorce of an owner, death/disability, key in person insurance, ownership restructuring, and litigation prevention. And the seventh scenario where evaluation reports help facilitate and can be of benefit to the end user is in a situation where they need to divide assets in divorce or separation. When a business is a marital or shared asset, value must be documented before it can be divided. And why does this matter? Well, first, it reduces emotional negotiation. Evaluation provides a common fact base. Second, separates cash flow from enterprise value. Income used for support is not the same as business value. Third, it clarifies entity versus personal assets. Cash, debt, receivables, and liabilities affect equity value. And fourth, prepares counsels and advisors. A formal appraisal may be required for litigation purposes. Business owners can benefit from an annual value history because it documents trends before a conflict arises. So for any valuation report to be rooted in reality, the inputs and the assumptions are imperative to get as precise as possible. And given my time studying for the CFA and eventually becoming a CFA charter holder, I have the knowledge, experience, and the capacity to be able to strengthen and provide credibility in that area. So we could focus on how to make those assumptions, inputs, and forecasts as precise as possible so you have an even more precise valuation report. So this video is not being sponsored by the CFA, but I did want to go over a little bit about the benefits of having a chartered financial analyst on your side to help strengthen credibility, precision, and transparency of the projections. So you'll be having better inputs, better discovery, normalized earnings, adjust one-time owner-related or non-operating items, pressure test projections, translate historical performance into reasonable assumptions, calibrate risk, evaluate customer concentration, leverage, margins, and industry cyclicality, run scenarios, base assumptions, bull, upside assumptions, or bear downside cases to show valuation sensitivity, document the story, connect the numbers to lender, owner, and advisor's decisions. And how does a specialist value of the CFA lens help lend credibility and more precise projections? Well, advanced financial modeling and valuation discipline, projection support for cash flow, reinvestment, and debt capacity, sensitivity analysis that explain what actually moved the value, and professional ethics framework and finance credential credibility. So the value credential is not a logo. It is a disciplined way to build, question, document, and communicate valuation assumptions. So, such as diligence and reasonable basis, use a rational process, support assumptions with research, and document the basis for projections. Model selection discipline, apply income, market, and asset approaches where relevant, avoid false precision. Third, risk communication, disclose limitations, key assumptions, and sensitivity of value to inputs. And fourth, ethics and independence mindset, separate fact from opinion, avoid misrepresentation, and communicate what the report is and what it is not. So why do we recommend that a valuation report be done on an annual basis, especially when it is appropriate for that specific business owner and their business given the size and profitability that they have? Because it is an annual strategic review tied to tax planning, banking, and owner's goals. So the process is collect data, like prior year tax returns, financials, debt schedules, etc., normalize them, review one-time, non-recurring, owner-related, or missing items, formulate projections, run those projections into the software so we can get a valuation output, interpret those valuation outputs, and compare value, key performance indicators, and changes versus previous year, and then act on that. Set priorities for sale readiness, loans, estate disputes, value growth, or whatever the owner's objective is at that time. So annual valuation reports creates clarity before the owner business needs it. And when the owner business needs it, in any of those scenarios or situations we provided before, it's going to be more costly. So it's better to plan for it, and proper planning prevents piss poor performance. So this is what we want to implement for our clients. And on one of the last slides, I wanted to talk to you about the methodology of that value. Usually when a company is generating revenue from 500,000 and under, you're only going to get one-time multiple on your earnings. If you're within 500K to 2 million, depending on other factors, it could be 3 times. 5 million to 10 million, that valuation multiple on earnings is usually 5 times. And then anything over $10 million in revenue being generated, usually the multiple is 10 times, depending on what the profitability is, concentration of customers, what the projected growth rate is for the following year, etc. And remember, it's better to invest in the umbrella before it rains. So CFA Institute disclosure. BizCPAs is not sponsored, approved, endorsed, reviewed, or warranted by the CFA Institute. CFA and Chartered Financial Analysts are trademarks owned by the CFA Institute. Valuation limitation. A planned evaluation report is not a certified appraisal, fairness opinion, audit, legal opinion, or guarantee of sale price. Court, IRS findings, and litigations may require a qualified appraiser or designated expert, approved by the court or the IRS. Professional use note. The CFA charter holder lens can improve assumptions, forecasts, financial normalization, sensitivity analysis, and communication. It does not eliminate uncertainty or replace legal/tax judgment. And don't forget to like, share, and subscribe. And stay tuned for our next video.
Know your value, plan your next move. Schedule a business valuation readiness call with BizCPAs today.